Well, joining us this morning is Research Head for First Metro Investment Corporation, Cristina Ulang. Welcome back, Chris, and a very happy new
Hi.
year.
Hi, good morning, Kathy. Happy to
Okay,
be here. Happy
yeah,
New
so
Year.
we're starting the year with economic growth forecast coming off on the PSEi. Where in the range are you leaning today, given those reduced economic growth forecasts? And what would make you upgrade or downgrade that target?
Well, the economy is still growing. The number may not be like 6%, but we are continuing to grow over what we have achieved last year. So we grew last year maybe like 5%. Some are saying it's 4.8, 4.9, but we are rising from that level. So I think the perspective should be properly contexted, which is we are still growing 5.3%. And then what is consistent with that growth in terms of the corporate earnings would likely be 7%. According to analysts, the consensus estimates could be 7%, best of 10%. And if that is the case, then we have this policy easing also and supportive fiscal budget of 6.7 trillion. It is very possible but that we can have an upside of as much as 10%, which could be like 6,700 for the PSA.
What
It
was the
may not
base
be a
case?
bull run,
Sure.
may not be
Okay.
a bull run, it's just 10% improvement, but once the governance issues are addressed,
But
who
that's
can
huge. And it's
say? Who
really the
can say?
governance issues and who can say when it ends. I mean, after speaking with
Mm-hmm.
Nomura's Yuben Paracuellas last Friday, and he said it might take two more quarters before the catch-up carries out. So in that respect, what kind of forecast can we have for the PSEI, at least for the first 6 months?
Well, in the what we're seeing now is a seasonal uptrend. Seasonally, we are on the approach to the Chinese New Year, and there's a lot of optimism. Usually, this is the year of the fire horse, and it means focus, focus, and maybe the focus could be growth, recovery, corrective actions on the governance issues. So we're really coming from a very low base, and I think that's really the big incentive for investors to come. You're not coming in cheap. You're not coming in very pricey at pricey levels. We're coming from a PE of 9, a crisis like PE. We're oversold. The foreigners have sold, like foreign investors have sold like almost 1 billion US dollars worth of stocks. And then we are also coming from the very low in terms of sentiment and also in terms of our GDP. So there seems to be no way but up and improvement towards progress, corrective action. So I think investors are going to be coming in at a very good level, good timing, but we will see volatility, of course. It cannot be a consistently upward movement, and yet that usually comes in the second quarter.
Yeah.
April and then May, sell in May and go away. So maybe we can have strength now, first quarter, and then maybe sell and then in the second quarter, and then the August is usually again a weak period, but we've seen strength last year in October.
Well,
Uh-huh.
if
And of course,
anybody can agree on
complicated.
something, it really is, Chris, valuations. They have been described as bruised after a spate of calamities, the corruption probes, and the risk off tone. So, do you see 2026 as a classic value rally year for the PSEI, or do you think that foreign investors will still demand a discount for the governance and liquidity
Yeah.
risks?
Yeah, the risk premium is really the concern. When will the risk premium on Philippine equities be tempered and be corrected? And I think that really depends on how government handles the process of this anti-corruption drive. And I think foreigners are going to be looking out for progress, for social justice, and of course there are news now that adds to the complications, which is this refiling of impeachment complaints, rumor of another impeachment complaint on top of one, and ongoing investigation of other agencies also for governance issues. So and we are, I think, towards 2028. Politics is really intensifying. So I think the economic managers are really very much in a very challenging situation now right now because they have to really pump prime the economy, stimulate the economy, and see to it that public investments the pace of spending goes back to normal. The ADB is saying it will take like four quarters historically for that public investment spending, the growth of that to normalize. So it may be a prolonged process, but the market is very forward looking Like for instance, now we're seeing a rally 6,003, we may be hitting 6,004 easily, largely on the corrective action in the governance front. And I think for 2027, if the forecast for GDP is 6%, then the market will really price that in. Maybe third quarter, fourth quarter of next year. Second half will be the swing period in terms of the big upside for
Right.
the
So it's
PSEi.
it's going to take some time then. If we just take it by a sector approach, how do you rank the opportunities this year amongst banks, property, consumer, info-related names, REITs versus the more niche themes like, say, the tech enablers and the data centers?
Well, Kathy, I see two themes this year. It's the quest for yields. Interest rates are dropping. Investors would want to achieve high yields on their investment. So they will be sticking to fixed income also, middle end and long end of the curve. And in terms of the risk asset, they will be looking for very sustainable dividend payers, generous payers of dividends, high dividend paying stocks to match that with fixed income, long high yielding fixed income. So I think it's the search for yield and therefore very defensive stocks. So the names would really focus on companies that will be able to pay dividends, generous ones, sustainably, not just because prices have come down and so the yield is high. I think that's very artificial. So investors should be looking at the strength of corporate earnings and those that are not really tied to the cycles, those that are really very defensive in nature. So we have a lot of names, of course. And then the second would be back to basics because of the moderation of the growth. Its discretionary spending is going to be a bit weaker. And so the back to basic stocks like Pure Gold, Jollibee is restructuring, listing the foreign operations. So that is an upside. And then, of course, Monde and all those CNPF, all those related to the basic necessities.
Let's take a look at those linked to the economy because banks, you previously said, fundamentals remain intact. And this is something that you said late last year, despite the short-term pain. But after the slowdown we've seen last year and the corruption overhang, how are bank loan books and earnings looking this year?
Well, the banks mirror the economy, and I think for as long as the economy is growing, the banks will benefit. But there's going to be a different tone with respect to competition. Competition is going to be intense this year because we know that interest rates are dropping, loan spreads are likely to compress. So there will be very tough competition in the field of retail finance, consumer lending, credit cards, auto loans, mortgage. So these are very high yielding high margin segment of the business, and so the banks are going to be focusing on that because the corporate lending is going to be faced with tempered spreads. And I think the banks are going to be aware of the need for more holistic approach. Of course, they're maintaining that relationship management and then the need for AI application for greater efficiency. And then, of course, very good credit screening because provisions need not go up. Provisions need not go up, spreads need not go down. So I think they will be embarking on very wise strategies to really tap the market very well. Very
So,
focused marketing, retail finance.
right, where are you then on non-performing loans, the credit costs, capital buffers for the sector? Is there any systemic risk or is it more of a stock-picking story among the big banks?
I think the banking sector is very healthy. We've seen the capital adequacy ratio like 17%, 16%, and then our NPL ratio 3%. For the big banks, it's 1.7% Metro Bank, the best in terms of asset quality. And I think the big banks have learned the lessons from way back to really take care of provisions and provisions buffer. Metrobank has one of the biggest provisions and really very, you're in good hands. Very aware of the shocks that may come in the future, and so better to be prepared. I think the banks are very prepared. We have a healthy banking system. That's why the foreign investors are still here. ADB is saying they're very much invested in the Philippines and will continue to be committed to the Philippines.
In terms of central banks, though, do you see room for the Bangko Sentral to ease meaningfully, or do you think that the Fed and global yields will keep local policy on a short leash?
Well, the communication now, I just heard from your news coming from the Deputy Governor of the BSP. I think they're tempering expectations for more rate cuts. But they're saying now it's nearing the end, but they're not saying it's the end. So they're going to be very data dependent, and I think they're going to be very careful because the peso is flirting with 59.29, and inflation on is on the uptrend a bit, but still within expectations. So I think they're trying to manage expectations and not to. But I think the factor also to consider would be the Fed and the yield differential between the Fed and the BSP. So they're managing the yield differential, but I just hope the Fed cuts more so the dollar weakens and we have this some kind of reprieve when it comes to the peso dollar rate.
Just as a final point on the peso, how vulnerable is the currency this year? And what forex range is consistent with your equity and bond calls?
Well, if you're going to look at the Big Mac index, if you're going to use that uh, uh, that approach in terms of valuing the currency, we're very much undervalued. The risk premium is coming from the fact that we have this governance issue and the fact that we are cutting interest rates. In last year, the peso was at 55. The previous year, the peso was at 55. That was our best. So if we remove the risk premium coming from the governance issue, I think we will improve. We're not going to be at 59. We will be reverting and appreciating to our more normal level given our remittances, our exports, which is rising like 14%. Our trade deficit has come down from like 50 billion to 45 billion US dollars. And then our current account deficit has come down also late print, 12 billion US dollars to 9 billion US dollars. So what is really just contributing to the BOP deficit that the BSP said is going to widen is because of the debt servicing and the fact that the foreign direct investment has come down 20%. So if we are able to cure our governance problem, then we can see a healthier foreign direct investment that will contribute to the betterment of our balance of payments deficit.
All right, there you go with the big if, but I'm going to hold on to your optimism there at the start of the year. Thank you so much for your views, Cristina
Thank
Ulang
you.
of First Metro Investment Corporation.